Welcome back to the deep dive. It feels like everywhere you look, everywhere you listen, there's this constant chatter about the economy. Uncertainty seems to be the word of the day.
Absolutely. And that R word, recession, it just keeps popping up, doesn't it?
It really does. I mean,
Yeah.
look at the surveys mid-August. The AAII sentiment survey had bears outnumbering bulls by, what, 16%? That's a pretty significant chunk of investors feeling quite gloomy.
A very noticeable gap. Lots of negative sentiment floating around.
Right, but what if? What if there's another way to look at things, a perspective that kind of flips that anxiety on its head?
Mm-hmm.
That's what we're diving into today, the big question. Can a really powerful stock market rally actually, well, kill the odds of a recession instead of just, ignoring them?
It's a fascinating question. And looking at history might give us some surprising answers about the momentum we've been seeing.
Exactly. So our mission for this deep dive is to unpack some of those insights, maybe challenge some common assumptions, and offer a fresh look at what these big market surges really mean. Let's get into it.
Sounds good.
Okay, so kicking things off with this really bold idea from our source material. Epic rallies kill recession odds. Now, I can imagine for a lot of you listening, feeling that unease, that might sound, well, maybe a bit reckless.
It definitely goes against the grain of recent commentary, doesn't it?
It does. So what's the thinking behind that? Why would a rally, even a big one, actually reduce the chances of a downturn? What's the logic there?
Well, the key is understanding how the market often works. It's not just reacting to yesterday's news, right? It's trying to look ahead.
Like a predictive engine, sort of.
Exactly. It's constantly processing huge amounts of information, earnings forecasts, spending trends, monetary policy signals, you name it, and trying to discount what might happen months, maybe even quarters down the line.
Way before it shows up in official reports or headlines.
Precisely. So these really strong rallies, they often happen before the economic picture looks obviously rosy to everyone. It's the market starting to price in that future improvement, that turn, well in advance.
And we've certainly seen a powerful rally. The S&P 500, what was it, up 28% since the lows back in early April 2025?
A staggering number. And that kind of speed and magnitude over that short a time frame, our source points out that's really, really rare historically. Only happened a few times.
That rarity makes you stop and think, doesn't it? It's not just a blip.
It's not. And that's where the historical data gets interesting. You know, the New York Fed's model? The one that uses the yield curve.
Yeah, the difference between short-term and long-term bond yields. Famous for predicting recessions when it inverts, right?
That's one. An inverted curve short rates higher than long rates has been a remarkably reliable warning sign, often signaling tighter credit conditions are coming.
Okay, so how does that model react after these big rallies?
Well, here's the crucial part. In the year following these powerful market surges, like the one we're seeing now, that model has consistently shown the risk of recession actually declining.
Declining, even if the curve was inverted before.
Yes. And specifically, for years following what our source calls these top percentile rallies, the really strong ones, like now the historical odds of a recession in the next 12 months, dropped to just 8%.
8%? Wow. Compared to what, like a normal year's odds?
Much higher. Historically, the average chance in any given year is probably closer to 20–25%, so 8% is significantly lower. It suggests the market, with its rally, is seeing something beyond those initial yield curve warnings.
That is remarkably low. It really challenges that feeling of inevitability that's been around. But are there caveats? I mean, is this pattern always ironclad?
That's always a fair question. No indicator is perfect, of course. But the research really stresses how consistent this pattern has been. It's not saying ignore potential problems, but that these huge rallies often happen despite the gloom.
Because the market may be overshot on the downside first.
Often, yes. Pessimism gets extreme, assets get cheap, and then when things start to look even slightly less bad or stabilize, the market reprices that fast. The sheer size of the rally is the key. It signals a big reassessment, not just noise.
So for you listening right now, if you've been feeling that gloom, maybe expecting that downturn, this history suggests you might want to consider what the market's collective intelligence could be signaling instead. Something different.
It's definitely food for thought.
Okay, so that tackles the recession odds angle, which is huge. But let's shift gears slightly. If these big rallies tend to squash recession fears, what do they mean for actual stock returns going forward?
Right, because the immediate reaction to a 28% surge might be, okay, we've come too far, too fast, time for a pullback.
Exactly. That feels like the intuitive response, doesn't it? Are we just stretched thin here?
Well, here's another piece that challenges intuition. The research finds the bigger the rally, the better the forward returns.
Really? Not the opposite.
Not historically, no. It directly pushes back against that too far, too fast idea. Let's look at the numbers. These top percentile rallies, like 2025's, historically, they've led to average 12-month gains of 17%.
17% on average. So, okay, that's strong.
But here's the kicker, the really standout stat. In those follow-up 12-month periods, positive returns happened 100% of the time.
Wait, 100%. Every single time after a rally like this, the market was higher a year later.
According to this historical data, yes, a perfect record in these specific instances.
Okay, that's pretty undeniable.
It's powerful. And even if you broaden it slightly, look at top decile or top quartile rallies, you're still seeing average next 12-month gains of around 13% and 12.3%.
Which is still way better than the long-term average, right? What's the typical S&P gain?
Around 9.6% annually over the long haul. So yeah, 12%, 13%, 17%. These are significantly better returns following big surges. It suggests strength often gets more strength.
Okay, I need to put that 100% stat somewhere prominent. But the big question, the deep dive question for you listening is why? Why wouldn't these just be, bubbles, irrational exuberance?
Great question. And the thinking is they aren't typically based on pure fantasy. Remember, they often come after periods where returns were bad or even negative, like April's near bear market, the source mentioned.
So pessimism got too high, prices got pushed down too far.
Exactly. The market priced in a lot of bad news, maybe too much. Then, as that forward-looking engine we talked about starts to see signs that the worst isn't happening or that the outlook is improving, even subtly.
It has to adjust upwards quickly.
Precisely. It becomes a catch-up trade. The market is recalibrating, adjusting to that improving reality, moving away from extreme fear towards maybe cautious optimism or even more. It's less irrational and more rational repricing.
Correcting its own prior pessimism. That makes sense. So for you, the listener, what does this mean when you see these big green arrows on the screen? If history says it's often a reevaluation, not a fluke, how might that change how you react to market news?
It encourages looking past the noise, doesn't it? Digging into the why behind the move.
Absolutely. Okay, so let's bring this down to brass tacks. If momentum is historically a reason to lean in, not pull back, and if this bull market might be broadening out, what does that mean for building a portfolio right now?
How do you put this into action? Yeah.
Where should you be looking potentially for the next phase of opportunity?
Right. Well, the source suggests, first off, don't abandon the leaders. Tech, financials, industrials, they've been strong for good reasons.
They've earned their stripes.
They have. And the source suggests they might be taking a healthy breather right now after those big gains.
Yeah.
So maybe view any tactical dip there as a potential opportunity to buy or add.
Okay, stick with the winners. But what about broadening out? You mentioned the winner's circle potentially expanding.
Yes. This is where it gets interesting, looking ahead, particularly into 2026. The idea is that as the economic outlook hopefully continues to improve, other sectors that have lagged might start to play catch-up too. Cyclical sectors, especially.
The one's more sensitive to the economic cycle.
Exactly. And the source highlights 3 specific sleeper sectors to watch. These have underperformed the S&P 500 so far this year, but they're forecast to potentially post the biggest improvements in year-over-year earnings growth come 2026.
Okay. Intrigued. Which ones are they?
They are discretionary materials and energy.
Interesting mix. Let's quickly touch on why those 3. Discretionary first.
Sure. Discretionary, think consumer spending on non-essentials, travel, cars, retail. If consumer confidence firms up, if people feel more secure about the economy, they tend to open their wallets for these kinds of things.
Makes sense. And materials?
Materials could benefit from a few things, maybe more global infrastructure projects, a pickup in manufacturing, generally more demand for the basic stuff needed to build things as economies grow.
Right, the building blocks. And finally, energy. Always a complex one.
Always. But the thinking here might involve factors like potentially tight supply due to past underinvestment, continued global demand recovery, and maybe broader inflationary trends that can sometimes help commodity prices.
So it's suggesting a potential rotation where leadership spreads out beyond just the current high flyers.
That's the idea, a broadening out of the bullish trend as the cycle matures.
So this gives you, the listener, a framework, not just is the market going up, But where within the market might the next opportunities lie? It's about being proactive, looking for that potential rotation.
Exactly. Diversifying into areas poised for that catch-up growth.
Okay, let's wrap things up. We've covered a lot of ground in this deep dive. The core takeaway for me is how these epic rallies, like the one we've seen, historically tend to reduce recession risk, not signal its arrival.
A really powerful counter-narrative to the prevailing gloom.
And just as compelling, how they've historically led to stronger future stock returns. That 17% average and 100% positive rate after top percentile rallies is just stunning.
It really challenges the sell-the-rip mentality.
Absolutely. And then we brought it down to the portfolio level, looking at sticking with leaders like tech, financials, and industrials, but also keeping an eye on potential emerging winners like discretionary, materials, and energy as the market possibly broadens out.
It all points to looking beyond the day-to-day headlines, doesn't it?
Yeah.
Understanding the market's forward-looking nature and trusting historical patterns, at least as a guide. It's about filtering this signal from the noise.
Well said. So here's a final thought for you to maybe mull over as you go about your day. Considering these strong historical patterns, considering the rally we've witnessed, what assumptions might you be holding on to right now about the economy, about market timing? Are they being challenged by this data? Is the market's bull whistle, so to speak, already blowing, even if the all clear doesn't feel obvious yet?
Are you waiting for a signal that's perhaps already been given? Something to think about how your own perspective might be framing the picture and whether the market's already painting a different one.